All right, y'all. Well, what's up? Thanks for joining us today. This is Jake from Home Loans. Welcome to the Home Loan Podcast, or Home Loan channel, really. This is the channel we talk about anything and everything having to do with the mortgage side of the real estate market. Here we cover everything from what you should know before you apply to a mortgage to interest rates, loan types, and even how to shop lenders. Today, we're going to be looking at the interest rates and how that's going to affect your monthly payment, especially with how things are just jumping right now. Absolutely bonkers. It's been absolutely crazy this last week. It's gone up almost 1.5%. So keep that in mind. We're going to talk about a little bit about what interest rates do to your monthly payment and how much that's going to affect you over the next couple months. So cool. Let's check it out. One of the biggest things that we've been seeing, so this last couple weeks has been just nuts with the mortgage market, with the rates. I don't know if a lot of you have seen, but rates took a massive jump this last week. So I actually quoted someone for an FHA loan on Monday, and they were at a 5.625. And then Tuesday I came back and looked at quotes again. They were at a 6.5. So just absolutely crazy jump in the market this week. And so what we're going to talk about again is Wednesday, the Fed actually met and agreed upon a rate hike of another 0.75 basis points. So it's going to be quite a bit. You're going to see the market continue to jump over the next couple of months. We're not going to be dropping anytime soon, according to them at least. So we'll kind of see the way they're trying to fight inflation is to raise interest rates past where inflation is at. So it's going to probably go up to 8, 9, possibly even 10%. Hopefully not super quick. But I mean, we've already seen it raise over 3% in the last 6 months, 6 to 7 months. So keep that in mind as we're going through. Today, I wanted to jump on and talk about what your monthly payment looks like as that keeps going up. So we're actually going to go through some basics. I'm just going to run a couple scenarios and kind of walk you guys through it. So if you guys get the chance, I'm going to talk through it for the podcast. But if you want to actually see the numbers for yourself, go check out the YouTube video that I'm posting as well. That'll kind of walk you through even a website you guys can use to look through amortization schedules. So if you want to run some of your own numbers, you can. Again, it's not a quote. Nothing today is going to be an actual quote for what's happening. This is all just basic numbers running scenarios. So today is not a quote. NMLS number 2117984. So not a quote today, not quoting your rates, not quoting your prices. I'm just saying, this is based off what's actually happening. So first things first, we're going to start off with, we're in Sacramento. Pretty low to median housing price right now is going to be about $450,000. So that's the first rate we're going to run. So we're going to kind of go through here to show you how big of a difference a monthly payment is going to be when you're going from, like today, I'm just going to run it at a 6.5%. That's a pretty average rate right now for this market. The other thing I do, you'll see, so $450,000 payment. I'm putting 5% down, which is a pretty low down payment. Property taxes, the way I calculate them out, is going to be 1.25% of the purchase price, and then homeowners insurance is about 0.35% of the purchase price. So that's what we're going to throw in here. Take away the HOA. PMI is not going to be exact because it's going to change depending on the home type. But as you guys can see here, you're looking quite a bit in property taxes, homeowners insurance. This is going to be looking right now, if you're going a $450,000 house with a 5% down payment, that's $22,500 at a 6.5% interest rate. All the numbers I talked about. Your principal and interest alone comes out to $2,702. And again, this is not a quote, just an estimate based off the numbers, just based running some numbers. So that's just your principal and interest. So once you actually include your taxes and insurance in that, you're looking $3,480. So your monthly payment on a $450,000 house with 5% down at a 6.5 interest rate is going to be around $3,500. Now, keep in mind, rates will change as you put more or less percentage down. This is just kind of an average number I'm using right now. Again, I said it enough times, not a quote. So I'm not quoting your rates. I'm not quoting you anything. This is just a scenario I'm running. So you're looking with 5% down, a 6.5 interest rate, about $3,500. Now, $3,480 is going to be your total monthly payment. So what I'm going to run next is I'm actually going to jump that. So same home price, same down payment amount if you're using the 7.5%. So say in the last the last 6 months, interest rates have gone up about 3%. We don't know exactly what they're going to do. They could slow down a little bit, but there's a good chance they're going to keep running at about this rate. So even with the 75 basis point hike they just announced, there's a good chance we could be in the 7s by the end of this month. Again, no one knows exactly what's going to happen. It's all going to play out, but this is going to run it through here. So it's running same price, same down payment, same property taxes, same everything. The only difference is the interest rate. Your monthly principal and interest goes out to $29.89. Now, your monthly payment goes $37.67. So you're looking 1% difference on the same price house with the same down payment. You're adding almost just a little bit under $300 a month. Now this is at a 7.5%. If rates keep going up to 8, 9, it's gonna keep going. So I just wanted to clarify the reason I'm running through these scenarios today is a lot of people are saying, well, the prices are gonna drop, prices are gonna drop, prices are gonna drop. So this next one I'm running is actually going to be if prices drop to, say we're going to drop 30 grand off the house price. So instead of 450, we're looking 420. Say you guys get an offer accepted at that. Even bringing in the same down payment or more of a down payment, you're paying almost as much monthly with the higher rate than you would if you were to buy now at a slightly lower rate for a higher home price. Because the biggest thing that I focus on, and I always tell people this, you can have your opinions, but even if prices drop, even if you buy a home at a lower price, even if you buy now and prices drop in a year and a half, unless you're planning on selling at that time, real estate is one of the markets that will always increase in value because there's only so much land. They can print more money, they can make more phones, they can do whatever they want, but there's only so much land. So as land gets less, real estate's gonna inflate. Real estate's gonna be worth the investment in the long run, whether you buy right now at a higher price or if you wait a year and a half and it does drop, which honestly I don't think it's gonna drop that much or nearly as much as you think. And even at that, if it does drop 20 or 30 grand and the interest rates are higher, right now it's looking like the interest rates aren't going to drop for a couple years. So if you get in a year and a half and interest rates are at 8.5%, 9%, you're going to be paying more for the next 4 to 5 years until interest rates drops and you can refinance than if you were to pay now at a higher purchase price and a lower interest rate for honestly the same house. And then you'll be paying more to the bank. So you'll pay less for the house technically, but more to the bank. So then, regardless, in my opinion, the housing price will go up eventually. Not a guarantee, but we've seen forever the market pretty much usually corrects itself after about 10 years. So you're going to be gaining equity regardless. If it's the house you want to buy and you're ready to buy, that should make your decision. Don't weigh everything on interest rates or housing prices. If you guys can afford it and it makes sense for you, look at buying sooner rather than later because it's an investment. You guys are going to be living there. You're going to be actually building equity. And so regardless whether it raises in value or not, it's, regardless, eventually you'll have the equity in that house. Even if you stay in it 15 years and the housing prices drop 20 years, 25 years, once you pay off the house, that whole thing is owned. That whole thing is yours. You can sell it. You can make money on it, do what you want. So this is going down to $420,000 home price. So I dropped $30,000 off the price. We're going to keep, we're going to actually jump the down payment up too. So we're going to throw 10%. So this is throwing an extra 20 grand in the actual down payment. And I'm doing this because a lot of people think, interest rates will go up, but housing prices will drop. I'll be able to save, an extra 20 grand to put in a home. So this is running that based off the original 5% down at 450 with a 6.5 interest rate. We're now looking 420 with 10% down. So adding an extra over 20 grand at a 7.5 interest rate. So 1% higher, same loan term, property taxes and home insurance, because they're based off the purchase price. I'm going to drop them a little bit right here, as you guys will see. So I'm going to keep that at 1.25, which is the same percentage as what it originally was. And then I'm going to run the quote. All right, so here we go, calculate. Now I want to stop for a quick second and just stare at this. You're looking $30,000 less of a home price and bringing 20 grand more, $20,000 more of your own money into the purchase. You are only saving if the interest rate's 1% higher and you're bringing $20,000 more of your own money in at $30,000 less, you are saving barely $110 a month when the percentage rates are up higher. So $110 a month for 20 grand more out of your pocket. Now, just to play with the numbers a little bit, just to add that up, if you're saving what? We'll make it pretty exact. So from 3360 to 3480, so $120 a month more. When you're doing that, $120 a month to save the 20 grand you just put in the down payment. Now, that to me, let's actually calculate it out. So we got 20 grand, and it's more than 20 grand. I'm just using that as an estimate. Divided by that $120 a month, it's going to take you 166 months to make up what you're saving in a monthly payment, if that makes sense. So I always calculate that, same as when I tell people if they want to buy down rate, I always calculate it the same way. So if you want to buy down rate, what we always look at is your long term. How long is it going to take you to pay off monthly what you would just spend on that rate? So how much is it going to save you monthly to be able to pay off the rate you just bought? So if you buy down $5,000, how much is that saving you per month? When will that add up to $5,000? So I do the same thing for this. So if you're looking at it and you're spending an extra 20 grand and it only saves you $100 a month because the interest rate goes up, $120 a month, it's going to take you 166 months. That is what? Looking at 13 and a half years in order to make the 20 grand back that you just decided to spend on that, instead of buying now and putting less down. It's literally, I run through that stuff, and that's what blows my mind. Until you actually see the numbers, you don't really realize what you're doing. So biggest thing I want to get out of all this is not to buy right now, but it's not to look so much at interest rates and home prices. It's to look at when you as a buyer are ready, because that is going to be the biggest difference in the housing market, is the difference when you are ready versus when you think you're ready. And so if you can afford your home payment, number one, you have to be able to afford it. It has to be calculate within your debt to income ratio. It has to make sense for you. If it doesn't make sense, then don't buy a home. But it has to make sense for you to buy. You have to be able to afford it. You will build equity eventually. It may take a couple of years, but if you're not planning on buying and selling and flipping and getting in and trying to turn it into, all the crazy stuff, if you're literally just looking for yourself, you want to buy a home and build equity, you want to live there, if it makes sense, it makes sense. If you can afford the payment, if you can afford the down payment, if you can get in sooner, you'll build equity sooner. And if you want to tell me that it makes more sense for you to wait a year and a half with rent going up 12% a year, if not more than that right now, you're spending what? Average rental right now for probably a 2-bed, 1-bath apartment is going to be $1,800. So $1,800 a month for the next year to wait on prices to drop, when you could buy a home with that money now, if you have it. I mean, you are spending, let's even run that out, $1,800 a month for the next year, paying $21,000 in rent that you could be building equity with. So that's my spiel for the day. More than anything, today's episode is to go in and show you that even if prices do drop, it's not necessarily going to make a ton of sense. So really, you need to look into buying a home if you're ready for it, and not hold back because of prices dropping or interest rates going down. Yeah, prices dropping does make it more of a buyer's market, which I agree is going to be a healthier market. It's going to be a better time to buy, even with higher interest rates. It's going to make more sense for you to buy because it's going to be easier to get in offers. You're not going to have to go way over asking price, which I believe is completely healthy and helpful, and that makes sense. So the biggest thing when you guys are looking at this, just go through it. Figure out what you're looking at, and then I wanted to run one more. So this one I did, keeping that same $420,000 home price, 10% down. So just like we just ran at the 7.5% interest rate, I'm going to run it at an 8, just to show you how much even 0.5% more does to your payment. So running this at 8% interest, that same home is now $10 more a month than the original one we priced out. So again, reminder, the original one we priced out was at a $450,000 home price with 5% down at a 6.5% interest rate, which is close to where you could possibly be today. At 30-year loan term, you're looking 1.25 property taxes and 0.35% purchase price for homeowners insurance. Total came out to $34.80 or your monthly. Now, this home, $30,000 less, an extra $20,000 down payment at an 8%, so 1.5% more than one of the possibilities for right now at the 6.5, the original quote we run. You're paying $34.91 monthly to bring $20,000 more out of your pocket. You are spending $10 more a month to pay $20,000 more dollars up front at an 8%. So keep this in mind. That's it for today. Sorry, this was a long one. This is a big one. I hope you guys found it helpful. If you like it, please go check out my Instagram. I try to do a lot of first-time homebuyer stuff, a lot of education on the mortgage market. And honestly, thank you so much for listening today. I hope you found it helpful, and hope you guys can think about it. If you have any questions or ever want to reach out and just try to price out something that works for you, please hit me up on my Instagram at Jake_from_homeloans. I'll always answer back. I'll always talk to you. So, all right. Until next time, that's it for now. Thanks.